Welcome to another installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. We aim to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets from a biblical worldview with no financial agenda, which makes us uniquely different from the news media in America. This video is for informational purposes only and should not be relied upon to make investment decisions. The clients of Whitaker-Myers Wealth Managers may maintain positions in the securities discussed in today's video. All opinions discussed are solely those of John Mark Young and not those of Whitaker-Myers Wealth Managers.
Hi, I'm John Mark Young, and happy Easter weekend edition of What We Learned in the Markets This Week. He is risen indeed. Matthew 28, 5-7 says, "But the angel said to the woman, 'Do not be afraid, for I know that you seek Jesus who was crucified. He is not here, for he is risen, as he said. Come and see the place where he lay. Then go quickly and tell his disciples that he has risen from the dead, and behold, he is going before you to Galilee. There you will see him. See, I have told you.'" When we think of the big picture of things, like our eternal salvation that was secured by Jesus' sacrificial death on the cross, which of course atoned for every sin we've ever made, it puts the stock market and the economy stuff into perspective. It's not that we don't care about it. It's out of sight, out of mind, because we are called to be good stewards. And as we know through the book called Gospel Patrons, that the gospel is able to be spread throughout the nations by the generosity of those whom God has blessed with abundance. But it's not our hope. It's important. It's how God uses the movement of the gospel, but it's not our hope. Our hope is the work Christ did on the cross that we celebrate this weekend. So let's talk about the markets a bit on this holiday shortened 4 trading day week. This week capped off by the first quarter. So we're all over with the first quarter for the stock market. And what a quarter it was. The best start to a year since 2019. And while it was a good quarter for the S&P 500, which as you can see on your screen, hit a whopping 10% for the first quarter, which in our Dave Ramsey language, the S&P 500, of course, is code for growth and growth in income, but only when combined, not when considered independently. The other two categories, they did have good starts as well, but not historically good starts. The Russell 2000, or aggressive growth, small to mid-sized companies, that charted up about 4.78%, and international stocks came in around 5.99%. Our internal and external research partners continue to believe that the aggressive growth space, the small and mid-cap stocks, is an area of the market that they would estimate has the greatest chance of having a very large year this year, because these Russell 2000 companies are set to grow revenues and earnings per share faster than the S&P 500 companies this year. For example, analysts expect an 18.6% EPS growth versus only 11.8% growth for the S&P 500. That 18.6 was for the Russell 2000. On top of this, valuations look better for the Russell 2000. They're trading at 10 times 2025 median earnings, while the S&P 500 is now trading at 17 times 2025 median earnings. All that to say, on Monday, we'll start a new week and a new quarter and get to see how things start to play out. Our best guess is based on the economic data we track each week. So let's take a look at that economic data. First, the Atlanta Fed's GDP Now model, which tracks the growth of our economy in real time, updated typically a few times each week as the data is released. And at this point, they're expecting growth of 2.3% after dipping to around 2.1 last week and earlier this week. This is after reports from the U.S. Census Bureau and the Bureau of Economic Analysis that came out this week. And an interesting note, as what happens every single quarter, the average of Wall Street economists is falling in line. See, they don't want to embarrass themselves too bad. They always start the quarter lower because they're just pessimists by nature. But as the quarter plays itself out, they come around to a close enough number. Right now, they're around 2% even. Next, each week we look at the 30 and 15-year mortgage rates to see if borrowers are getting any reprieve in the housing market. This week, the 30-year mortgage rate averaged 6.79%, which was down slightly from the previous week, and the 15-year mortgage hit 6.11%, and we are anxiously awaiting that number to drop back into the fives like it did last year before it popped back up. And finally, data around the initial and continuing claims for unemployment insurance to see how the front end of the labor market is looking currently. The initial claims for unemployment insurance this week came in at 210,000 initial claims for unemployment insurance. People getting on unemployment insurance for the first time. They're still staying at their historically low range. Next, the continuing claims, those that are on unemployment but have not been able to find work, they have come in around 1.81 million, staying in the range we'd like to see them stay in. And finally, we look each week at what the markets did. Now, we did that for the quarter already and earlier, but how about how they turned out for the actual week, the holiday shortened week, which was only 4 trading days, Monday through Thursday. First, the S&P 500, which is our proxy for growth and growth in income, but only when taken together, that was positive 0.39% this week. The Russell 2000, which is our proxy for small and mid-sized companies, or aggressive growth in our Dave Ramsey vernacular, that was positive, 2.55% for the week, 2.55%, having a monster week. And finally, the MSCI EFA, which tracks international stocks around the world in developed markets, excluding the United States, that was positive 0.28% this week. So it was no contest, aggressive growth with the monster whamma jamma slamma win. And point number 2, a stat we often quote to clients is a small number of days make the market. A small number of days make the market. And you can't time those days, so you must buy and hold throughout the good, this last quarter, and the bad, 2022. This is all about behavioral finance, which is why we spend time training our advisors and associates on behavioral finance techniques, because it can literally make or break a portfolio. The first quarter of 2024 was no different. In the first quarter, we saw 32 days that generated a positive return, 32 days positive return, and 28 days that generated a negative return. Think about that. Basically half and half, and we had such a great quarter. The 4 best days of this quarter were February 22nd when NVIDIA reported their fourth quarter earnings, and the stock exploded, and that pushed up the S&P 500 up 2.1% that day. The next best day was January 8th after the market started with a bunch of losing days, making investors worry about how this year would look, because when you get negative days on the front of the year to start the year, that's typically not a great sign. However, on January 8th, we saw the S&P 500 jump 1.4% thanks to the technology giants who have boosted us so much the last few years, giving us a boost on that actual day. Then on February 1st, we saw the markets jump 1.3%. After declining 1.6 the day before, which was after the first FOMC meeting where we learned rate cuts were not coming as fast and as furious as we had hoped, yet cooler heads prevailed the next day. Market had a nice day. And finally, the fourth best day. That day was January 19th, when the markets jumped 1.2%, and this was the day that finally got us back to even after declining almost all of 2022, making that year the worst year for the stock market since 2008. So from 2022, beginning of it, all through 2023 and the early part of 2024, you finally got back to break even on that day. So if you made an investment in 2021, you finally were even. And that's just the way the markets work. But the point here is not a single person could have picked those days correctly. And even if you did add them all up, the 4 best days, you're still only at 6%. So if you traded the market perfectly on those 4 days, got in on those out at the end of the day, you would have to be the best investor in the world. That's not what anybody is. Point number 3. On Tuesday of this week, presidential candidate and former President Donald Trump, his social media company, Truth Social, started trading on the public markets under the ticker symbol DJT. The stock valuation currently puts the company at around $8 billion in total worth, and former President Trump owns about 60% of that stock. So his investment on that company is worth about $4.5 billion as of today. Now, those valuations are swinging pretty wildly, so much so that the NASDAQ actually temporarily shut down trading of the stock following its opening. And the question that many are asking is, will Trump actually sell some of this stake to help pay for his $175 million bond he has to put up, which was put on his $454 million civil fraud, which of course got the bond actually got lowered on that judgment, which is on hold during an appeal. Typically, an owner like Trump can't sell stock for roughly 6 months unless granted a waiver by his board, which in Truth Social's case is Donald Trump Jr., Robert Lighthizer, Kash Patel, and Linda McMahon, among some others, but those are the more popular ones. And options tied to the stock have been trading like crazy as well, with the most bought option tied to the shares ending around $80 to $90 a share. By the way, shares on Thursday closed at around $61.96. So if you haven't, maybe you should consider starting an account with Truth Social, the actual social media, where the former president is one of the most active users and has followers of around 6.8 million. Now, that sounds like a lot, but to put that into perspective, he has about 34 million followers on Facebook and about 87 million followers on X, which is formerly Twitter. Although he, of course, formed Truth Social because of the unequal treatment he received on platforms such as Facebook and Twitter. Probably not Twitter anymore, thanks to Elon Musk, my guy's purchase of that, the political town square. And finally, point number 4. On Friday, while the markets were closed and much of America celebrated Good Friday, we still got some important economic data that was released that morning. The data that was released was the February PCE, or Personal Consumption Expenditures report, that came out. Now remember, this is the Fed's preferred, what they actually want to look at more than anything, inflation gauge. So put bluntly, it's the most important. And the fact that it was released on a Friday, that the markets were closed, means that if it's probably going to move the markets on Monday, this coming Monday. The report came in with year-over-year numbers hitting 2.78 on the core side of PCE year over year, thus no volatile food and energy in that number, and 2.45 on the headline figure, while the monthly changes came in at 0.3% on both of them. Everything was in line with what was expected, other than the monthly headline number, which of course is the non-core number, which came in slightly below analysts or economists' expectations. Fed President Jerome Powell on these numbers said these were more along the lines of what they wanted to see, and that was good news for the market, or will be good news for the market. When comparing the service side of the economy versus the goods side of the economy, the two sides of our economy, service and goods, we saw that on this report, goods rose 0.5% from January, while prices for services rose about 0.3%. The same time last year saw services increase 3.8% and goods decrease 0.2%. So positive momentum in terms of more normalized numbers in terms of goods and services. The largest category changes were from housing, no surprise there, that's continued to be a big driver, recreational goods and vehicles, clothing and footwear, and hospital and nursing home services. All that to say, it was a good report and one that the market should hopefully respond well to on Monday when they open up after closing down Thursday and being shut down on Friday for Good Friday. So hopefully the 4 things in the markets this week were helpful to you. If they were, would you do us a favor? You can do us a favor by hitting the like button and the subscribe button. The like button helps push our content out to more people on YouTube, Rumble, and so that our content can help people experience financial freedom through the baby steps, as well as hitting the subscribe button allows our content to be pushed out to you as soon as it is released. Additionally, if you'd like to schedule a meeting with any of our financial planners or coaches, you can go to the comment section of this video. In the comment section, you'll find a link that you can click on, and that'll allow you to schedule a meeting with our coach who can help you in baby steps 1, 2, and 3, get out of debt, stay out of debt, live debt-free, build a budget, hold you accountable to that, as well as our financial planners and advisors who can help you in baby steps 4, 5, 6, and 7, start saving for retirement, kids' college, build out a plan to pay off your house early so that you can get to 7 where you can live and give like no one else. Thanks so much for watching this week's video. Have a great, blessed, and happy Easter.